Welcome back to the channel, Sagely Investors. My name is Kras. Good to have you here. In this video, I'm going to talk about the recent dividend announcement from Vanguard Australia with regards to 3 of their ETFs, which I hold in my portfolio. Now, the dividend announcement was quite disappointing, as we're going to see, compared to their historical average dividends that they've paid out in the past. So for instance, VAS, Vanguard Australian shares, in July 2020 are paying out 21 cents per share. Historically, they have paid an average of 81 cents per share. VAP is paying 76 cents per share. VHY, which is Vanguard High Yield, is paying 23 cents per share. And VAP, Vanguard Australian Property, historically has paid $1.08 per share. And Vanguard High Yield has historically paid $1 per share. So obviously these dividend payments in July are disappointing, but considering everything that's happened with the economy recently, it's not unexpected. So in this video, I just want to give you guys my thoughts about where I think these ETFs are going in the next 6 to 12 months, and also talk about some of the stats behind it. So clearly you guys can see that I've downloaded the historical dividend data for the past 3 years, and I have translated the July dividends for the last 4 years, for the last 4 July payments in these corresponding graphs. So the idea behind this is to basically illustrate visually the significant drop from July 2019 to July 2020. And lo and behold, what we can see is that the drop in the upcoming dividend, July 2020, the drop from the average dividend payment is 75% drop for VAS, 30% drop for VAP, and 77% drop for Vanguard High Yield. All right, guys, now having said that, I'm going to jump into the concluding thoughts. First of all, the lowest drop in dividend payments from VAP, the commercial property real estate ETF, was somewhat surprising to me. From everything that I've heard regarding people getting grace periods on their mortgages and businesses getting grace periods on their loans from the banks, I was quite surprised to see that the real estate investment trusts have still been collecting, nearly 100% of the rent that they were collecting before. Okay, it's 30% less, but that is surprising. I was expecting something in the order of at least a 50% drop in rent, so that's positive. That means that commercial property is still chugging along, and we'll have to wait and see for the October dividends from VAP to confirm that theory that commercial clients are still paying their way through this crisis. Number 2, there was a big drop in dividends, as we all know, as we can see, but stock prices have recovered to near all-time highs. So what on earth is going on there? Well, it ties back to interest rates, and it also ties back to what's happening in the behemoth stock market that is the USA. So we tend to follow whatever happens in the USA, and also the fact that interest rates are currently hovering around the 1% mark if you have a online savings account. Stocks offering an average of 4%, or right now, as we can see, a theoretical average of 4% to 7%, are going to be priced higher because naturally people are happy to pay a bit more for that yield. But as we can see, based on the new numbers, the new dividend yields are not looking that good if we extend those dividend yields into the future based on the current stock price. So something is going to have to give. Either the economy will recover and we're going to see an average dividend yield of 4%, 6%, and 8%, and the stock prices will remain as they are, or we will see a drop in the stock prices to reflect the lower dividend yields over the next potentially 6 to 24 months. We have to wait and see. Point number 3 is that VAS and VHY had an identical drop from the average, practically identical. So this speaks volumes to me, because it's telling me that to a large degree, these two funds are having a similar reaction to the economic crisis, and the companies within those funds, to extend that thought, the companies within those funds are acting in a very similar fashion. They're becoming more conservative with their payouts, and they've decided to make very significant dividend cuts. And we know that the banks, the big banks, which comprise 25% of VAS and about 30% of VHY, they have actually cancelled all of their dividends. So they're not paying any dividends. So it makes sense that these ETFs, which collect the dividends from their constituent stocks, are also not paying high dividends. Point number 4 is that lack of dividends do not appear to be deterring investors. And again, this harkens to the previous point that we are in a very unusual environment with extremely low interest rates. So with extremely low interest rates, you can't beat inflation if you keep your money in the bank account. So very low interest rates effectively are forcing everyone into the stock market, into property, and that's keeping those prices relatively high compared to the new dividend yield. And if we just look at the difference in the drop between the average dividend yield and the new dividend yield, if you will, the Vanguard high yield has seen the most significant drop, the most significant difference drop in dividend yield. And that has to do with the high yield companies, typically being blue chip companies like the BHPs, the large banks, the CSLs. And these companies, larger companies typically tend to have more conservative management. And in times of great uncertainty, typically management take very conservative decisions, especially around how they spend their cash. We have recently seen a lot of large companies go for capital raisings, and they have gone for capital raisings very aggressively. And that's saying that management is worried about the next 12 to 24 months. So everybody is acting very conservatively, cutting their dividends, maintaining their cash, and basically trying to bolster their balance sheets. Point number 5, the final point, is that I think October dividends are very likely to be the same as the July dividends. And there's 3 reasons for that. Number 1 is that unemployment is very high. There are a lot of people out there in Australia that are on JobSeeker, that are on Centrelink, and it seems that they're not being hired back by the companies where they used to work at. So I don't think that 3 months will magically fix this problem, and I think that there is a direct correlation between the economy and the stock market that will not persist for forever. So right now there might be a bit of a discrepancy. The economy is doing pretty poorly, but the stock market is going up. And again, that's very likely because of interest rates. But the two eventually do correlate. And the next 3 months with maybe more people becoming unemployed, or the unemployment rate not improving, we could see that issue play out. The second point is that international travel is not going to be open probably until 2021. And while international trade is still chugging along quite nicely and still working, tourism represents 4-5% of the Australian economy. So where are those companies? Where are those individuals and businesses going to get that income from? That income stream is gone for those people. So because of that, we're not going to see the previous levels of projects, the previous levels of investments in new projects by this sector, which creates a lot of jobs, and creates a lot of revenues and profits for a lot of the companies contained within VAS, VAP, and VHY. And the third point I've already mentioned, which is that managers of these large companies, ASX 300 companies, REITs, and blue chip companies in VHY, a lot of these managers are very cash conservative. So because this uncertainty that we're experiencing right now is likely to persist right up until October, November, December, towards the end of the year, potentially into the first half of 2021, this uncertainty around the economy and how governments are reacting to this virus, this uncertainty will persist, and the game plan of these managers and these companies is likely to remain the same. They're likely to be very conservative with their cash, which means that they are unlikely to increase their dividend payments in October. We'll have to wait and see whether they start increasing them in January 2021 and beyond, but I would err on the side of caution. And right now, I am not buying anything for the simple reason that I think a lot of income investors who are in these stocks and have been in these stocks for a long time, they may start to seek alternative investments in, let's say, property, potentially other financial instruments that offer them a higher yield because they depend on that yield. So guys, that wraps up this video. I hope that you enjoyed my thoughts on these three ETFs, and if you guys have any questions, please feel free to ask. So I'll see you guys in the next video.